Okay. So, hello again.
Hello.
Hi, I'm Michael BACIA. I'm from Web3 Economics, and we're going to be talking Web3 economics today. And I'm joined by Mert, Apurav, and Parth. And these guys were the first brave souls who reached out to me on LinkedIn, where I offered to discuss token economics with people and projects. And yeah, I'm excited to meet you guys. And I, I like your questions. I think they are very useful. A lot of people probably have similar questions. Um, Before I'm gonna let you present yourself a little bit about my background. So I'm a trend economist with a background in project finance. I've joined the Web3 crypto space in 2017. I've been working with over 20 Web3 projects and enterprises designing and auditing token economics. I'm also, practicing what I'm teaching. I'm a co-founder of 3A DAO, which is a DeFi protocol that enables zero interest lending, and it's completely decentralized and managed by a DAO. And I'm also offering my expertise as a service, so as a virtual slash fractional chief token economist. So if you need advice, please reach out, and I can tell you more about the plans that I'm offering to projects and companies. And let's guys, the floor is yours. Introduce yourselves briefly and talk about your project, please.
Okay, sure. So let me introduce myself first. By the way, it's great to have a recording with you. Let me say this first. I have 2 years of experience in data science and 1 year experience in Web3 developer. And I have a master's degree from Cardiff University from data science and analytics. Currently, we are working in Wakaru. It's a Web3, blockchain startup offering blockchain solutions for startups, enterprises, and companies at the moment. We have
So
we offer.
what kind of solutions? I mean, who would be your perfect client?
Okay. First of all, we offer smart contract audits with the tool that we wrote. Secondly, we offer software solutions to our clients. They come with their design, their idea, and we offer them software services. We also have our own projects at the moment that are called crypto finance, Web3 wallet solution in the name of Token, and real estate solution project in Web3.
Excellent.
Yeah,
Sorry.
Parth, you can go next. Yeah.
yeah. Hi, Michael. Thank you for letting us be at a single platform and discuss this. So, I'm an undergraduate student studying engineering right now in electronics, particularly, but my interest mostly lies in blockchain. That's where I started exploring Web3 as a space. Went to multiple meetups, met a lot of new people. Uh, that helped me gain some network and did some projects with them, collaborating with them. Particularly, a major project that I did was on the Hyperledger Fabric platform. It was in the domain of philanthropy, and currently in Wakaru, I'm as a head of growth department, where I'm looking in structuring of the company for the future forefronts and working to build solutions on the clientele forefront as well as on building products. So, like Mert said, the major three modules in Wakaru that we target is consulting, the second one is auditing, and the third one is development. So we accept all kind of development works when it comes to startups or enterprises that require development for their products. Also, when it comes to product, what we are aiming is when people want to transition from web 2 to web 3 and they do have an idea but they don't know how to implement or on what platforms they want to implement, we help them guide end to end from the basic ideation stage till the go-to-market strategies. So this is particularly one thing about Wakaru, and the other thing would be, like Mert said, is the OKIN project, which is particularly a wallet infrastructure that we are trying to build for a real estate investment platform. This is
Excellent.
particularly, yeah.
Excellent.
I'll go next. Hi, Michael. Apurva this side. I've been into Web3 since 1 year. Specifically, I'm interested into DeFi and finance. And my major projects have also been in that field itself. And currently, I'm pursuing bachelor's in engineering. Apart from that, in Wakaru, I work as a lead researcher. So my main task is to research on various Web3 trends and topics, and majorly on analytics of DeFi protocols.
Excellent. So I hope token economics is also on your research list.
Yeah, 100%, 100%.
Excellent. Mickey, are you gonna introduce yourself, turn your camera on, or are you just listening in today? Okay. Oh, there's the man.
Hello everybody. Apologies for joining a bit late. I missed the timing a bit. My name is Mickey. I'm a blockchain researcher at Wakaru. I've been in the blockchain space for about 2 years now, mainly as a research worker. So I carry out research work for various DeFi protocols and basically write articles on them just to shed more light on kind of on how good investments are with those protocols. Currently at Wakaru, I work alongside Apple as the blockchain research. So we develop various articles, deep dive articles on various topics in the blockchain space, from DeFi infrastructure to very common news, in the blockchain space, and then we work on projects together. I'm really interested in token economics. I've taken some courses on token economics before, but I haven't been able to fully get a full, deep dive understanding of that. So I'm saying that because once I heard your comments to Apple regarding token economics, I was quite excited. So it's something I'd actually be looking forward to. Yeah.
Great stuff. Excellent. Good to have you guys over here. So the agenda, I mean, these are the questions that Matt shared with me beforehand. So we're gonna discuss each and every one of them, and then if we still have time, we will be able to cover anything else that comes up, or anything else that you would like to know. Okay, so Mert, I mean, this is your question. Over to you. What specifically would you like to understand over here?
Okay, so let's say that we have built our project. And after that, we also presented our idea, etc. Then what is the next step? I mean, how can we prepare or launch crypto token so that it can meet with some audience? They can buy. I mean, they can invest some tokens from DeFi pool such as Uniswap. I mean, how can we define the initial price? And from which companies, or let's say from other social media stuff, where can we find these investors, specific investors?
Right. Okay. So first of all, I think it's very good for every project to understand why do they need a token. Is it gonna help facilitate adoption, or is the token gonna have a governance function? Is there gonna be any specific utility inside the protocol that the token is helping with? And I would really advise to design a token release strategy based on this overall goal of, let's say, what do we need the token to do in our ecosystem. And I also think that having a product first and then having a token is definitely a way better approach than starting a project by launching a token and trying to sell it.
Yeah, can I add something? But at the initial phase, we are also presenting the utilization of this token, and we will present some any simulation maybe. I mean, we are not just launching a token and investors. We are not saying like this. We are presenting supporting documents.
Look, I understand that the token can have several functions, and one of those functions can be fundraising. I understand. Right?
Okay.
But what I'm trying to say is that if your only purpose for launching a token is to fundraising, then you clearly need a security token, which basically means that you're offering a share of your project to investors, and you definitely should do, let's say, all the required preparations and steps and due diligence to actually launch a security token, which probably means that you would have to only, restrict your offering to accredited investors, have some sort of a KYC process, and again, I'm not a lawyer, so please don't take it as any legal advice. But if you decide to offer security token to investors, there is this whole, let's say, legal aspect and compliance aspect of it, and you definitely need to contact the say competent legal advisors in your desired jurisdiction. Now, if you are thinking about having a utility token, then it really helps if the utility for this particular token is present the moment you're going to launch the token, which basically means if you can launch your product or launch your platform or launch protocol or whatever else that's going to be using this token first, and then even the next day you're going to launch the token, there is this reason for having this token. Because if, let's say, you have a utility token that is used to, I don't know, get access to your protocol, well, then of course you need to provide the way for people to actually hold this token, interact with your protocol, and then maybe buy this token or swap with somebody else. Right? So okay. I know it might sound a little bit basic, but I would say always lead with the purpose. I really don't like seeing people launching tokens thinking that it's going to solve all the problems and then going to figure out the purpose later. Because if you launch a token and you start selling it, then you just might put yourself in a whole bunch of trouble. Because what can happen is you can have a situation where number one, you might be breaching securities law by offering unregistered securities to retail investors, right? You can have a situation where you will be a victim of some sort of a pump and dump scheme when somebody's gonna buy a token, shill it on social media, pump the price, and then sell it, and then the price of the token crashes, and it's very difficult to recover from it. But I would say so. If you have a, let's say, really good reason for having a token, then if you are doing a protocol that is truly decentralized, I think a good idea would be to have a liquidity pool on a decentralized exchange in order to give people the ability to, let's say, swap this token. So people who want to use your protocol and product will be able to buy it, and people who don't want to use it anymore then will be able to sell it in this pool.
Okay.
Yeah.
And like you said, yeah, and like you
Sure.
said that first of all you should be aiming to build a product and then deploy a token around it. So do you think that implementing tokenomics after building a product that has gained credibility in the market would definitely boost up the value of the product? Like, what do you think? How much tokenomics plays a role in like engaging more with the product?
I think, look, if you decide to have a token, it's not a, let's say, silver bullet or a miracle solution to all your problems, right? But I mean, there are cases that can definitely help, and there are cases that a token and token economics around it is the only solution that will let you do certain things. But what I can say from experience is that definitely if you have bad token economics, it's going to kill your product and it's going to kill your project. So I would even say that, you know, if you have a project or a platform or any solution that you're offering that doesn't need the token and it just works, I mean, maybe you don't really need the token, because if you have a token, you have a completely new layer of risks and processes and complexities, right? Because now you talk about compliance and regulation, you talk about governance, now you talk about stuff like how is the user experience affected by the price fluctuations of my token, right? Are my users only using my product because the price is pumping? Well, what's going to happen if the price going to go down? Is everybody going to leave, right?
Mm-hmm.
And I mean, there's really a lot of stuff to consider over there, but I would definitely maybe recommend doing the following. Don't think about the token price as a metrics of a success of your project. You need to apply different metrics, like, I don't know, number of users that are using your platform, or even number of those token holders. That's a decent metric. So it's just, you know, don't attach the idea that when the price is pumping, we are doing something good, because what it means is that, well, number one, you have no control over the sentiment overall on the overall market. And maybe it's not really you doing anything. Maybe you just got lucky because, you know, somebody mentioned your token and it started trending, right? And the second reason is that when the market sentiment changes and people start selling a token and the price goes down, then, you know, you don't want to be in a situation where there is something outside of your control that, let's say, shows that there is something wrong with the project, right? It doesn't necessarily have to be there. I just like, if you look in the traditional finance world, you have shares and stocks of companies, and yeah, if there is a, let's say, bull run, all the shares are trading higher, and when there's a bear market, all the shares are trading lower, and it doesn't mean that those companies are doing something good or something bad necessarily, right? So think about, let's say, from the point of, let's say, your communications and your engagement with your community, to sort of not buy into this idea that the token price defines you somehow, right? And I mentioned community, right? I think community and token in Web3, I mean, they go hand in hand. If you don't have a community, then your token will be meaningless. And if you want to have a token, you probably also are thinking about creating a community or an ecosystem around your solution. And then you can use the token to, I don't know, orchestrate this community, facilitate adoption. You can do a lot of good stuff, but definitely you need to find your community. You need to find people that believe in your vision and believe in your product, and say engage with them and treat them as very important stakeholders of your entire project.
Also,
Can-
also, do you think?
yeah, sure. I can ask later.
Yeah, I was asking that, do you think by doing tokenomics, is it a good way for the adoption of community building around the product? Like in terms of just community building, not in terms of product?
Yes, I think having, let's say, working on good token economics with your community, I think it's a good idea. And listening to their feedback, and also, let's say, including your community into the governance process that defines tokenomics. I think it's a good idea. I think it's a good idea.
Can I ask something related to the metrics that you mentioned? What do you think the importance of holder token percentage? Let's say that there is a guy and he has 30% of this token. Is it a red line?
Well, not necessarily. It depends, how this person got. Because, think about it. If you have an asset that can be traded on a decentralized exchange where there are no limitations, you just have a wallet and you can buy however much you want. There is a possibility that there will be one or two wallets that are gonna start accumulating all of your tokens, right? I mean, it would be good for you to know who these people are and what are their intentions, because you don't really want to be hostage to somebody who's gonna say, look, I can crash the price of your token and basically decimate your community by selling the tokens I hold, right? And let's say there is also this interesting interesting dimension if you are using your token for governance and you have, let's say, a mechanism where one token equals one vote. Well, whoever holds the majority of the tokens basically can influence the governance of your protocol, of your project, right? So you need to look out for that. And I think, I mean, that's a good segue to this question, right? So, Matt, what are you trying to understand? Let's say, what do you mean by algorithm?
So at the initial release, we define some price, right? And
Yes.
people need to buy it. I'm talking about DeFi pool.
Yes.
So as they buy, it's going to increase, right?
Yes.
The price of the token. But
Yes.
Is there anything else that can influence that price, like the transaction count on the projects, etc.?
Okay, so when you have a DeFi liquidity pool on a decentralized exchange, it is a smart contract, and the, let's say, only thing that influences the price in this particular liquidity pool is the supply and demand. So how much people are buying or how much people are selling. And I would say right now there are two main, let's say, algorithms or formulas which govern those liquidity pools. One is this Uniswap V2 style constant product formula, where the liquidity of both assets is spread between 0 and infinity, and basically means that the higher the demand for one token is going to be, the higher the price is going to be. And this formula is designed for the pool to never run out of the token to sell, which basically means that the less and less of this token is left in the pool, the higher of its price is going to be, right? And what it means is that if you have not a lot liquidity in this pool, a large transaction can move your price one or the other way quite significantly. Right? And this is what people call slippage. Probably heard about this, right? So if I have a spot price right now of, I don't know, let's say 20 cents, because you have some utility token paired with, I don't know, let's say USDC. and then you get 10 cents USDC per your token. And if there is not a lot of liquidity, if somebody comes and buys a lot, then this price can move quite significantly. Let's say by 20%, by 50%. And the opposite is true as well. If you don't have a lot of liquidity over there, then if somebody sells this utility token, the price is going to move down significantly. So in this way, there is supply and demand, and the key variable that determines the price movement is the liquidity in the pool, which basically means that how many tokens of each of those tokens in the pair are locked in the liquidity pool. And I would say it gets a little bit more complicated when you are talking about the Uniswap V3 style decentralized exchange, because Uniswap V3 introduced what's called concentrated liquidity, which basically means that whoever is depositing liquidity to the pool can decide what is the price range in which the liquidity is deposited. So it doesn't necessarily have to be from 0 to infinity. It can be, we discussed this example of, let's say, having the spot price of 10 cents. I can decide to provide my liquidity between 5 cents and 15 cents, for example. And then depending on, let's say, how the different providers deposit their liquidity over there, then this price will be affected in a different way. Where there is a lot of concentrated liquidity, it takes a lot of volume to move the price one or the other direction. Right? And if when the liquidity is thinner in this particular band, then the price is going to move faster over there. But so. And in order to, I mean, you can calculate this because it's a formula inside the smart contract. And I mean, if you or anybody else listening is interested, I mean, you can send me a message. I have a spreadsheet that you can basically plug in your variables, and then it spits out what's going to be the price movement for different liquidity levels. So.
Okay, that will definitely help. You will send a message.
Yeah. Shall we move on to the next one?
Yeah, sure.
Okay. So token allocation for who or where? Please tell me more. Give me more context.
Okay. So let's say that we will produce 100 million crypto tokens initially.
Yes. Yeah.
And how many of them should we allocate to our investors? How many of them should we allocate to potential clients or development team, etc.?
Okay, great question.
Most importantly, how many should we keep open for the initial, for the ICO? How much should we keep open the tokens?
Yeah.
Okay. So my question to you would be, why 100 million? Why not 100 billion or 10 million?
100 million.
Yeah, but
I just made it up.
Oh, you just made it up. Okay, because I would say there is an interesting question: how many tokens in total you should create, right? And and how to approach this. But let's say you decided on 100 million. Now we are assuming that you only want to have 100 million tokens, and you don't want to create any more. Right, that's going to be the total supply that ever going to be created, right?
Okay.
Yeah.
Okay, we can assume it like that. There is no mint after we launch it. Okay.
So there is no mint, right? So I would suggest if you are creating some sort of a protocol or a service or product that's going to be used by a broad community, I would suggest maybe around, say, 30 to 50%, around 40 maybe, of all the token to allocate to different types of incentives for the community.
Okay.
Where you're basically going to share those tokens with people doing something valuable for your product and for your protocol. And this can be spent on, I don't know, referral rewards or on grants for developers doing something for your product, or on let's say liquidity mining incentives on providing liquidity in a DEX, this kind of stuff. And again, I mean, look, this is really not something that is set in stone, or there is like only one way of doing it. We're just assuming that, because we don't have a lot of specific information from you guys, we're just assuming that this is going to be some, let's say, decentralized protocol doing stuff, something. Then the second allocation, I would say, whatever is left, I think, so let's say around half goes to the community in different forms of different incentives, and the remaining half you need to split between your team, your investors, and maybe give something for the project itself as a treasury for it to finance itself. And there is no really anything right or wrong how to divide it. I would say what you need to think about is the perception of your project by the investors and your community, and also, let's say, the power you give to different stakeholders with allocating different amounts of tokens. And let me give you an example. If you're gonna have a team allocation of, let's say, 45%, and then you're gonna have your investors and treasury the remaining 5%, the investors probably not gonna like it, and the community probably not gonna like it, because they're gonna look at it as a cash grab operation. And on the other hand, if you're gonna have a budget for your team that is insignificantly tiny, then I would say a reasonable investor would ask you, how are you planning on attracting top talent for your project? You need to have resources to make sure that the best people work on your project, and they're not gonna leave immediately. So I would say it's more of a, let's say, negotiation practice between those stakeholders, and I think it should be balanced, and it should also represent the contribution of each of those stakeholders to your project. So what I really want to point out over here is that definitely, I would say always a good practice is to have some sort of a lockup investing schedules, specifically for the team. And what you really want is you want to give people long-term incentives to keep contributing to the project. And on the other hand, we know that, you know, different things happen in life, and even if you have your co-founders, they might have different life events, or they might decide that they are on a different path right now. There definitely should be a way to sort of divorce amicably and say, okay, you've contributed to our project for a year, here is the allocation for you for this year. But if you were a CTO and now we need a new CTO, we also need the budget to give to the new CTO, right? And this is why this sort of lockup and vesting is so important, I think.
Okay, great.
Yeah, actually, I have a question. It
Yeah.
might be vague, but according to your experience in the tokenomics, what have you seen in the trends? A dynamic tokenomics, which can be mintable or which can be burned, turns out to be a better business model, or like a static one with a.
Nice. We already had this question prepared.
Yeah, this is the next question actually, or the fourth one. You exactly asked it.
I had one question. So what do you feel the initial price should be of this token? It should be according to the product, or it should be a very generic price?
Oh, okay. Okay. So let's go over this mint and burn question because it's already up on the screen, and then we're going to talk about the initial price. So I would say the token supply in total, or how you're going to manage the token supply, should be optimized for whatever goal for your project and for your tokens. And let me give you let's say some specific examples. Imagine you are incentivizing using your product, let's say, and you want to keep people motivated coming back, sort of like let's say you want to use your token almost like a loyalty reward system. Well, then I think it's quite appropriate to have a, let's say, mint and burn function where you are rewarding people for doing something using your product. You just mint more of those tokens to give them, and then they can redeem them for something. I don't know, for your services, or for, let's say, some extra benefits they get. And then you remove these tokens from the supply, and then you burn it. And this way, people who are not engaging, they are basically getting diluted, right? So if I just hold this token passively and I don't really engage with the protocol or the community, what's going to happen over time if there are more and more people joining and more people using the product and minting their tokens? Well, my supply is going to become less and less significant of a percentage of the total supply. And this is to sort of create this incentive for people to actually engage with your protocol. However, in this particular case, you might think that this particular token is not a very good investment because maybe the price is not going to change that much over time. So if you really want to have a situation where you incentivize early adoption and early investors, then having a fixed supply globally is a good idea, because then you're saying, okay, I'm going to invest in this particular token and I'm going to buy 1% of the overall supply. I have a guarantee that I will never get diluted, right? That my share will never be smaller than 1%. Now, yeah.
Can I say something really quick? So
Sure.
you emphasized a really good point. So most of the people, from my point of view, most of the people do not engage with protocol, even if they buy the token. They just buy it. They just see the vision in the protocol. They just buy it and hold it, right?
Well, yeah, it can happen. It can happen. But let's say this is a question of who are you designing the protocol for, and then who are you offering the token to, right? Because the best that can happen is that the community that wants to use a product is also the community who wants to hold this token because they believe in it. Because then you have all the incentives aligned, right? Because if I hold this token and I use your product because I love it and I think it's great, then naturally I'm going to tell everybody about this because it's going to help me directly, because the value of my token is going to appreciate if I do that, right?
Okay, great.
Yeah, but I mean, yeah, you definitely, this is something you really need to pay attention to, because if you're going to have just a community of completely passive holders that don't really care about the product that you're creating, yeah, you can have hard time actually gaining traction and adoption for your protocol.
Okay.
Yeah. And I would say about burning, I'm not a big fan of burning because it's like taxing people who are doing something beneficial and transferring this value to people who are not doing anything for the protocol. Because think about it, if you're going to start charging a transaction fee, and then this transaction fee is going to be burned, what basically is happening is that whoever is engaging in those transactions have to pay this tax, this transaction fee, and whoever is just holding token and doesn't do anything, they get all the value because they are not getting burned. See what I'm saying? So I would say maybe there is a valid use case for burning, especially if there is a mint and burn mechanism, like for example with loyalty reward points. If you earn points, then you mint them, and then when you redeem points, you burn them. Yeah, I don't have a problem with that. But I'm really not a big fan of just saying, hey, we have good token economics because we have a burn mechanism that is going to diminish the supply over time. I mean, yeah, okay, but I mean, who are you rewarding and what are you incentivizing? That's a question.
Okay. I have one more question. I know the time is up, but can I ask?
Yeah, go ahead. I don't have a hard stop. Go ahead, sure.
It was a previous question, but do you think, is it a good practice to restrict the amount of token the client can buy? Let's say that we don't want a guy that holds 30%. Remember, should we restrict the amount, the potential amount that they can
great,
buy?
but how are you going to do it on the blockchain?
Yeah, we can write functions inside smart contracts. I'm not sure exactly, but
well,
what do you think?
So okay, so you can restrict the token supply for each wallet. This is fine, but then how are you gonna restrict people from having multiple wallets?
Yeah, that's another point. Yeah, you're right. So, but maybe in the future, they can build an ERC solution for that, for people, against people who have multiple wallets.
Well,
to
look,
do that.
so I flipped to a different slide because now we're going to have a little bit of a freestyle conversations, and let's cover all the other stuff. So I really am not a big fan of restricting ownership or transferability of the tokens or anything like that, because I'd say the fundamental value proposition of crypto and Web3 is self-sovereignty. The fact that you hold your assets and you do what the hell you want with them. So I would say, other than some sort of a vesting schedule, I would really not encourage limiting the ownership of all these tokens, unless now we are in the realm of regulated security tokens, and you have people that are KYC, then you know their identities. Fine, you can do it. But I would say if this is a truly decentralized setup where you just have wallets on chain interacting with the protocol with each other, number one, I don't think it's possible to implement any restrictions like that, because you can create 100 wallets in MetaMask with a matter of 100 clicks for free, right? And number two, I mean, if somebody wants to game your system and somebody wants to take advantage of it, they're going to do it anyway. You just need to design a system that is not gameable. This is the point. So we had one really cool question about the price of your token. So I think the most, I would say, reasonable approach would be something like this. When you have any early stage startup, you agree on the valuation of this startup. And when you launch it, you say, okay, I don't know if it's worth 2.5 million or 5 or 10 or 20. Think about your project and the, let's say, total token valuation in similar terms, right? So I would say, if you have an early product that is actually working and you have a team that is experienced and you are, let's say, doing something that you started getting some traction in the community, I think if you're going to consider your valuation somewhere between 5 and 10 million in total, I would say this would be reasonable. Yeah, that would be reasonable. And then what you do is you divide this number you're going to come up with by the total token supply, and here is the price per token. And this is how you start. And let's say, mind you, if you get a lot of excitement around your project, the price can go up. But I would encourage people to, let's say, pay attention to the price and don't let it go too high too quickly, because if your price is gonna go too high too quickly because of poor liquidity in your DEX, the only thing it can go is down. And when you have a project that the only thing for the price movement is down, then nobody wants to touch it in the future. And if you look at, especially the bottom section of, CoinMarketCap or CoinGecko, if you look at all those projects at the bottom of the list, there is a very, very, let's say, there's a very sad pattern that you can see, that somebody's launching a token, and on the price chart, the price goes up, right? There's a spike, and then there's a dump, and then there's just like a slow and steady decline. Like it's a downhill slope from there. Right? And this is difficult for the project and for the community, because if you look, let's say, how much those tokens were worth on the first or second day, right, versus how much they are now, you need to think about how much work has to be done in order to even reach this initial level. Right? So this is why I really think it's a very good idea to start, let's say, with a very realistic price, and don't hype it, and put a lot of liquidity on the sell side of your token. So if there is an excitement and there is a rush and people want to get in your ecosystem and buy a token, then this is going to be represented not necessarily by a very sharp upward price movement, but it's going to be, let's say, accumulated through volume and through a lot of liquidity. Yeah.
Okay,
Good.
thank you.
Right. I think that made everything clear.
Yes,
Good.
absolutely.
Anything else, guys? So I think before we started recording, you asked a question about the institutional finance getting into Web3 space, right?
Yeah.
So, look, I'm expecting that it's gonna definitely happen. Probably not most people think about that. I definitely see a lot of interest from traditional legacy finance in this idea of tokenizing different assets. I think this is definitely going to be a trend, and there is a lot of very interesting projects out there that are working on solutions like that, and there's a lot of interest from traditional finance, like the biggest financial institutions in the world, in that space. I mean, the benefits of tokenization are very clear for everybody right now. Transparency, security, lower costs, the, let's say, idea that you can have very composable products in a very easy fashion, and the fact that you are creating products for a global market. I think those are very, very good reasons why people would like to tokenize their assets. And I think this tokenization is going to happen gradually, and we're going to start with stuff that is the easiest to tokenize. So everything that is already in a digital virtual form is going to be tokenized first, right? So, your shares, bonds, bank deposits.
All these synthetic assets, you mean?
No, I'm not talking about synthetic assets. I'm talking about assets that, because synthetic assets are assets that follow the price movement of a real asset, but they're not the asset itself.
Exactly.
So this is some sort of a let's say, asset that gives you exposure to a price of a certain asset, but it's not a price, but asset itself. I'm talking about tokenizing actual shares, like, for example, Apple shares or Tesla shares, Microsoft shares, that actually are the tokenized representation of these particular shares, where basically whoever is holding those tokens, they have the ability to, for example, redeem them for those actual shares, right? Or they can have those ownership rights, like, participating in governance of this company or receiving dividends, this kind of stuff. I think this is way more exciting than synthetic assets. And I think there is a lot of work being done right now that nobody's talking about, that is very boring, because it's all about compliance and regulation. So it's about having, being able to have a broker license for crypto assets, or being able to have a custodian license for crypto assets, right? And I mean, look, there are really serious businesses in this space working on it, and I think it is absolutely clear for me that everything that can be tokenized will be tokenized in terms of assets. We just don't know when. But it's a similar trend, like, you look back 20 years and you look at the fact that not every company was on the internet 20 years ago. Yeah.
Or maybe social media, like not every company was on social media 5 years ago.
Exactly. Yes. So, I mean, the trend is very clear. I just, never, let's say, I'm never able to tell anybody some specific timings of things. This is, I mean, there is a lot of stuff that is happening, a lot of stuff in the mix. But the trend is definitely there, and I would say big finance is definitely looking into crypto, and let's say they're gonna do their own, let's say, tokenization stuff, definitely, but they're also gonna be looking at crypto as a different asset class. But they're definitely gonna start from the very top of the coin market cap list, right? It's don't expect JP Morgan announcing that they invested in some obscure Web3 protocol that's number.
Ones.
I'm sorry?
They'll start from the very popular ones, like.
Yeah, they're gonna start from the very top, right? So Bitcoin and Ethereum, and then they're gonna move their way down slowly and cautiously.
100%. Okay, thanks a lot. It was great interacting with you. Maybe we can take a quick picture and then we can post it on our official Wakaru Twitter as well.
Go ahead.
I guess.
Go
Mickey,
ahead.
switch on your camera for that. Are you there?
Yeah. Give me a second.
Yeah, switch on the camera for 1 second.
Okay.
Yeah, everyone can smile, I guess.
Who's taking the picture?
Part, I think.
Done. Thanks a lot, guys.
Thank you so much.
Thanks a lot, guys. I'm gonna
Yeah,
stop the
Yeah, thanks a
recording
lot.
now.
Okay. Did you stop?